Welcome to this explainer. Today, we're diving straight into the vast and, yeah, sometimes intimidating world of financial markets. I want you to picture a really bustling neighborhood supermarket. But instead of wandering down the aisles grabbing fresh produce or bread, the shoppers here are trading financial assets. We're going to break down exactly who is shopping, what they're actually buying, and how this invisible engine literally powers our entire economy.
To help us navigate all this, here is our quick agenda. 1. What are financial markets? 2. Money versus capital markets. 3. Inside the money market. And 4. Key money market instruments.
All right, let's kick things off with Section 1. What are financial markets?
At its core, a financial market is simply any place where the creation and exchange of financial assets actually happens. It exists wherever a financial transaction takes place. This could be a brand new company issuing shares to raise money for the very first time, or it could just be investors, like you and me, buying and selling existing equity shares, debentures, or bonds. Basically, if financial assets are changing hands, boom, you're looking at a financial market.
Now, these markets basically perform four absolutely crucial jobs. First up, they mobilize savings and channel them into the most productive uses. Think of it like taking money that's just sitting idle in your bank account and putting it to work for a business that needs to build a new factory. Second, they facilitate price discovery. All that constant buying and selling, that's what actually determines what a stock or bond is worth in the real world. Third, they provide liquidity, which just means you can easily convert your financial assets back into cold hard cash when you need it. And fourth, they drastically reduce transaction costs by bringing all the buyers and sellers together in one highly efficient place.
Moving right along to Section 2, Money versus Capital Markets.
So we actually split the financial ecosystem into two distinct halves, and we do this based on how long it takes for their instruments to mature. The real game changer here is the difference in time and risk. On one side, we have the money market. This is the short-term arena. Everything here matures in up to 1 year. And because the timeline is so short, the risk is lower, which means the returns are generally lower too. Now in India, this is primarily regulated by the RBI, the Reserve Bank of India, and it's mainly used for short-term working capital or quick cash flow needs. On the flip side is the capital market. This is for the long haul. We're talking maturities of over a year. Think equity shares or long-term bonds used to start a totally new business or fund a massive factory expansion. It carries way more risk, but obviously greater potential return, and it's overseen by SEBI.
That brings us to Section 3, Inside the Money Market.
For the rest of this explainer, we're zooming our magnifying glass strictly into the money market. In India, as we just established, this space is exclusively for short-term funds, maturing in a year or less. And the absolute heavyweight champion and regulator of this space is the RBI. But they definitely aren't acting alone. They work hand-in-hand with commercial banks, cooperative banks, and even massive non-banking financial companies and institutions like the Life Insurance Corporation of India, LIC, and the General Insurance Corporation, GIC, just to make sure those short-term funds keep flowing smoothly through our economy.
Now, it's really important to keep in mind that this whole ecosystem isn't just one perfectly neat integrated unit. It actually operates across two different segments. You've got the unorganized market, so think of local moneylenders or informal credit networks, and then you have the organized market, which is strictly regulated and highly standardized.
Let's dive into Section 4, Key Money Market Instruments.
Okay, remember, everything we're about to look at is strictly for short-term needs, less than 1 year. Let's start with a highly specific but incredibly common real-world scenario. Imagine a major commercial bank gets to the end of the day, they tally up their books, and they realize they are just slightly short on the exact cash reserves they are legally required to hold. How do they fix a massive problem like this instantly, literally overnight?
Well, they turn to the interbank funds market. If they only need the cash for a single day, they use what's known as call money, which is basically an overnight loan. Now, if the cash crunch is going to take a little longer to sort out, they might use notice money. That's for funds borrowed for anywhere from 2 to 14 days. And the wildest part about this? For these specific interbank transactions, absolutely no collateral is required, none. Banks trust each other enough, and the timeline is so unbelievably short that they just lend millions back and forth entirely unsecured.
But hey, banks aren't the only ones who occasionally check their wallets and find them a bit light. The central government frequently runs into temporary gaps between the tax revenue coming in and the expenditures going out. So how does the government get a quick cash injection when they need it?
To solve this, the RBI steps in on behalf of the government and issues these highly liquid securities. They're called Treasury Bills, or T-bills, and Cash Management Bills, or CMBs. Now, what's really fascinating here is how you actually make a profit on them. They don't pay out monthly interest like a normal savings account. Instead, they're issued at a discount to their face value. So, for example, you might buy a 100 rupee T-bill for, say, 95 rupees today. When it matures, the government hands you the full 100 rupees. That 5 rupee difference? That's your profit. Also, commercial banks absolutely love holding these, especially the CMBs, because they count toward the mandatory statutory liquidity ratio, or SLR. That's essentially the emergency cash stash banks are legally required to keep on hand. As you can see here, T-bills come in 4 very specific maturity flavors: 14-day, 91-day, 182-day, and a maximum of 364 days. That keeps them strictly under that 1-year money market limit we talked about. Cash management bills, on the other hand, are designed for even more urgent cash flow mismatches, so their tenure is always going to be less than 91 days.
So, we've covered how the big commercial banks trade cash, and we've seen how the central government raises quick funds. But what about everyone else? What about mutual fund companies, big corporate entities, ordinary individuals, or even regional rural banks? How do they get a piece of this short-term action?
They use something called a certificate of deposit, or a CD. These are issued by banks and permitted financial institutions. Individuals, corporates, mutual funds, they can all buy them. But there is a catch. They are issued in minimum denominations of 5 lakh rupees and in multiples of 5 lakh after that. So it's definitely a more substantial investment. Their maturity ranges anywhere from just 7 days up to 364 days. Oh, and here's a really vital recent update. Previously, regional rural banks weren't allowed to issue CDs at all, but in 2021, the RBI officially gave them the green light, which opened up huge new avenues for rural liquidity.
Finally, let's talk about the corporate giants. If a massive corporate entity needs to raise short-term funds to finance their working capital, say they need to buy raw materials or pay seasonal workers, they use commercial paper. This was introduced in India back in 1990, and it's essentially an unsecured promissory note. Think of it as a giant formalized IOU issued by a corporation. And because it's completely unsecured, only companies with rock-solid, highly reputable credit ratings can actually get away with issuing them.
So, we've covered call money, T-bills, CDs, and commercial paper. As we wrap up this explainer on the money market, I want to leave you with something to really chew on. When you deposit your salary or your savings into your bank account, it doesn't just sit in a dark vault somewhere. Your bank is actively using it. So, based on all these short-term instruments we just discussed, where exactly do you think your own money is sitting right now? Is it funding an overnight interbank loan? Or maybe it's helping bridge a government cash gap via a T-bill? Think about that and get ready, because next time we are diving into the high-stakes, long-term arena of the capital markets. Thanks so much for joining us for this explainer.